Hi everyone, good afternoon in the UK and Europe, and good morning in the United States. Welcome to our first session of Friday for the Prospectus 2021 conference. And today I'm delighted to be joined by some experts on the investment side of the insurance and reinsurance business model. Not an area that I spend a great deal of time personally, so I'm delighted that we've got some real experience in the panel today. They're going to help give us an outlook for what, in particular, chief investment officers should be considering as we move into 2021. Obviously, 2020 has been a testing time for anyone focused on the asset side of the business model, with a global pandemic that has driven significant volatility, threatens ongoing strategic challenges, and an even more accentuated return to a lower for longer rate environment as well. With that backdrop, our panelists are going to discuss their outlook for 2021 and beyond as the world emerges from the shadow of COVID, explaining what chief investment officers need to concern themselves about, and also how they can position themselves for the future. So I'm going to do some brief intros. We are joined today by Van Hesser, Chief Strategist from Kroll Bond Rating Agency, Jason Pratt, Head of Insurance Fixed Income with Neuberger Berman, Vin Delucia, Chief Investment Officer with New England Asset Management, and Paul Norris, Managing Director and Head of Structured Products at Conning. There'll be a chance for live questions and answers during the session, and we'll probably get to those at the end. But for the audience, you can see a box on the screen and you can enter your questions at any time. So we're looking forward to a vibrant discussion on key issues related to the asset side today. And I'm going to kick things off by turning to Van and saying, perhaps you could start us off with a brief intro to yourself and an overview as to how KBRA sees the impact of the pandemic to the investment side so far.
Happy to, Steve. Thank you for the introduction, and welcome to everybody. Thank you for linking in. Glad you could join us. So by way of background, I've been a market participant, quote unquote, for probably upwards of 30 years as an investment banker, a sell-side research analyst, a research director, and an institutional investor. I'm a bank guy by trade, which kind of puts me at the center of things. It certainly was that case back in the global financial crisis. But as I broaden out my reach and talk about things more broadly than just banks, banks has always been a good grounding because it touches so many parts of the world we operate in. Let me briefly talk about some of the things that are shaping the way we view the world, both in 2020 and now as we transition into 2021. Back in April, we wrote about 4 forces shaping the investing landscape as we looked into the dark tunnel of COVID, and we think they still hold true today. The first being, don't fight the Fed. Right now, we would include Congress in this effort, the point being that $3 trillion in relief plus backstopping financial markets is a remarkable statement, especially with the implication that there is more of that where that came from. 2, allowing for a reopening. Right here, the lasting point is that policymakers came to understand that you need to balance the cost of the health crisis with the cost of lockdown. Still applies today as we go through a second or third wave. 3, the growing humanitarian crisis. We saw this as a negative that could weigh on market sentiment, but the fact of the matter is the impact of this has been blunted by the size of stimulus. And 4, progress on the cure. Never before have we had essentially every scientist on the planet focused on one thing, and we felt a steady stream of headlines would keep short sellers of risk on the sidelines. Now, as we look ahead, we think about the following, right? Starting with the vaccine, 90% efficacy. If true, Pfizer and BioNTech's announcement implies that herd immunity is a very real possibility in 2021, something we were very skeptical of as recently as a week ago. So this is an important breakthrough. 2, the U.S. remains the cleanest shirt in the laundry. Right? Investor trust in its economic engine and its institutions has given it a pass in currency and rates markets, allowing it to continue to print money. Now, we also think about the behavioral reset that COVID triggered, something that touches individual, commercial, governmental activity, This is the economic drag that will result from not only the scarring as a result of COVID, but also the secular changes that are taking place. And for that reason, we believe the recovery will be slower than expected, and unemployment will remain higher than the more bullish forecasts out there, most notably the Fed's. Steve?
Great, thank you, Van. Great intro there. So next we're going to turn to Jason Pratt from Neuberger Berman, and I'll ask you to give a brief intro of yourself and explain how your team has been helping insurers and reinsurers navigate this challenging time.
Sure. Steve said, my name is Jason Pratt. I head up insurance, fixed income, and portfolio management globally for Neuberger Berman, where we manage about $53 billion for insurance clients of all types and jurisdictions. As a firm, we manage about $370 billion across asset classes, from publics to privates. I was previously CIO of Montpelier Group in Bermuda, and I've worked across fixed income markets and insurance portfolios for what I have to admit has been almost 30 years. Neuberger, like a lot of firms, has a dedicated global insurance solutions group of professionals across portfolio management, insurance analytics, and relationship management, the idea being that no two insurance clients are alike. I think having those resources was extremely important as we managed through this crisis, because we were positioned to help clients measure the impact of making tactical moves opportunistically into things like extended fixed income markets. Lessons learned from the past, and the great financial crisis, I think, drove a lot of that thinking. Examples, could include accessing the CLO market or high conviction, high yield portfolios. With the dramatic move in rates, there were unique opportunities in certain cases to reposition risk through the teeth of the COVID storm. So I think having access to the full spectrum of fixed income markets and the integrated expertise across a global platform gave us an edge to kind of manage through that environment. Noting that size is important, but having access to markets is crucial in order to be nimble and take advantage of those market opportunities in what ended up being a pretty short window. I think we'd all agree. The last thing I'd say is that, while the news around the vaccine is directionally positive, the market environment is still very challenging, and the need for creativity and access to unique ideas remains high.
Great, thank you, Jason. So now I'm going to turn to Paul from Conning, and perhaps you could give us a brief intro about yourself and your responsibilities, and also about how Conning has managed the initial effects of the pandemic on the asset side.
Sure thing. Thanks, Steve. I'm Paul Norris. As Steve mentioned, I'm from Conning Asset Management. A little bit about us. We're pretty exclusive insurance asset manager, around 160 billion in assets. As for me, I run our structured products and quantitative teams. And basically, we're working with our clients to ensure that they're comfortable and understand the risks that we've taken. So I think one of the things that we've seen post-crisis and during crisis was really fielding calls from clients and making sure that they understood the risks that we'd taken for them and gave them ideas to take advantage of the crisis. Much of what Jason and Van had really intimated, I think, was we saw the same thing. First, people were scared. Second, they want to know what's the opportunity and how to take advantage of it. And I think, Jason mentioned that it came and went so fast that clients were almost dumbfounded, as we were, in that, you woke up one morning and the Fed had instituted all the programs and spreads were a few hundred basis points tighter and the opportunity evaporated. So it's quickly back on the phone with clients, explaining that these are the new sets of opportunities. And I think unique to insurers is that there's a dearth of yieldy opportunities for them. And so for us, going back to what we're doing, it's finding new asset classes for them to invest in. And, hopefully we'll get a chance to talk about some of those things later.
Great, thank you, Paul. Yeah, it's an interesting time. Obviously, everybody's had to adjust to the new normal. Vin from New England Asset Management, perhaps you could give us a brief intro as well, and maybe talk a little bit about how, or if you had to pivot your own strategy, perhaps, to provide better client service and continue continual client service this year?
Sure. Thanks, Steve. I appreciate the opportunity to talk to everybody today. My name is Vin Delucia. I'm the Chief Investment Officer at New England Asset Management. NIAM is, again, like Conning, an insurance-focused asset manager. We have $77 billion or so of third-party assets under management, largely fixed income. We do have equities under management as well, but the vast majority of that is fixed income. In addition to asset management, we do a number of other ancillary services for clients, portfolio analytics, accounting, et cetera, on several $100 billion worth of assets on those services. So that's a little bit about us. As far as the challenges that this year has put in front of us, I mean, it's difficult to understate the whipsaw that we've had this year, as the other gentlemen have really talked about already. But we came into 2019 just in terms of to give you a sense of what we were talking about with clients. Our take was that coming into the year, really there weren't a lot of opportunities in credit markets, or for that matter, equity markets. Valuations were stretched, spreads were tight. So we were fairly defensive coming into the year. Our positioning was really up in the capital structure and really higher in the credit rating spectrum. And wow, did our positioning change come March? Really a complete 180. We certainly did have clients that were, as Paul described, worried about the impact of this on their businesses. So we did have, a number of clients that had to kind of hold back for a while, but we had the vast majority of our clients ready, willing, and able to participate in the market dislocation. So we were fairly aggressive getting money invested across markets, primarily corporates, I would say. That's where we did the vast majority of our spread duration extension, if you like, but also fairly aggressive in other areas, structured securities, taxable munis, basically funding that activity with agency mortgage-backed securities at first, and then once things settle down, basically doing extension trades within sectors. So it's been a difficult year. The health news has been, from a human perspective, very difficult to absorb. Very unfortunate. We did try to do what we could, though, to add some value to client portfolios, and we have managed to add a fair amount of yield in that brief window that both Jason and Paul talked about, that will be durable in what now appears to be a low rate, low spread environment for who knows how long. So I guess I would characterize it as, certainly making lemonade out of a couple of lemons there.
Thank you, Vin. So thank you, gentlemen. That's a great sort of overview from each of you. So with that, I'm actually going to hand over the moderator role now to Van Hesser from Kroll Bond Rating Agency, as this discussion's probably going to get a little more technical. And I'll leave it to you guys to discuss some of the technicalities about what you're seeing in the investment markets today.
Terrific. Thank you, Steve. And again, welcome to everybody. I thought we'd drill down a little bit on what the macro landscape looks like. I think you can get an appreciation now for the whipsaw or roller coaster, pick your analogy, of how investment professionals have had to ride through 2020. And yet here we are staring into 2021. We still have a fair amount of uncertainty out there in terms of the timing of the vaccine, how all this is going to progress. And we're looking at an opportunity set where, again, stretched valuations and tight spreads kind of rule the day. So what I thought I would do is be a good idea to have each of our panelists take a few minutes and drill down a little bit into their outlooks for 2021. We did get past a couple of big hurdles here in November. The American elections now in the rearview mirror. like to hear your thoughts around the implications of that, as well as sort of the virus or the vaccine rather, and how you time your investing decisions around that. Now, for context, I'd say the Bloomberg consensus for U.S. GDP growth in 2021 is 3.75%, and the 10-year Treasury yield is forecast to be all of 1.1% at year-end 2021. So within that context, let's go down the line. Have each one of you give us your 30,000-foot view and talk about some of the defining features that form your investing philosophy here as we go into 2021. Vin, care to kick us off?
Sure, be glad to. Yeah, as far as the consensus estimates that you talked about, Van, start with the GDP estimate of 3.75. That seems like a reasonable estimate. What we've had thus far is a drawdown of 32% or something like that on second quarter GDP, and then a bounce of 33%. It's basically the start and stop phenomenon. We're still below where we started the year by a decent margin. We do think that that'll continue to improve as time goes on. So I think that's a fair estimate. Whether it's 50 basis points above or below, I think that's probably fair. As far as interest rates go, again, that consensus, if I had to take an over and under, I probably would take a slight over, but not by much. If 110 or 111 is the number that you threw out, I can certainly see 40 or 50 basis points higher on the 10-year than where we are now. But that presupposes that we do get a durable breakthrough on the vaccine front and a rollout, at least a partial rollout of that in the first half. So that's our forecast, if you like, is a little bit higher than that, 111, but not by much. But it does presuppose that we get good news on the health front. As far as election results go, it would appear that we're going to end up with a divided government. That's the best we know at this moment, and certainly that is I guess it depends on your viewpoint. It's a good news, bad news situation. The good news is it's generally good for financial markets. Gridlock tends to keep our esteemed politicians from doing anything that is too radical. So that's the good news, is the stability. The not so good news, though, is that you're less likely to get big structural changes in sort of the underlying economy, if you like. And if you are the Fed and you're trying to engineer inflation that is sustainably above 2% for some period of time, I would suggest a divided government is going to make it harder to do that. So our best guess, if the election results hold out and the Republicans hold the Senate, our best guess is that you get a lot more of the same, which is consumer price inflation that's quite muted, and asset inflation, financial asset inflation that continues to sort of rule the day.
Yep, thank you for that, Vin. Jason, what are you seeing out there? How are you thinking about 2021?
Well, I'd echo Vin's comments. I think my approach would be to sort of do a quick around the horn in terms of different markets. Just thinking about the impact of the election and virus. In investment grade credit, I think Vin's comments earlier around where we started the year are interesting, because we went through this 10 minutes of recession, came out the other side in a unique place. Credit issuers actually have more leverage, and we have tighter spreads, or at least spreads that are close to those pre-COVID markets. So, while issuers have a lot more liquidity across both investment grade and high yield, what they do with that liquidity next is the thing that matters. And I think that features in our expectations around the election outcome and how fast a vaccine kind of finds its way into the system. So we really see an environment where idiosyncratic risk will be in play in the form of M&A, as that likely increases. And interestingly, it's probably the case that stronger rated issuers drive this because they've got the room. And maybe that results in the size of the triple B landscape increasing relative to the overall credit market. But the big takeaway there is that given our starting point with respect to yields and spreads, the margin for error is razor thin as we think about total returns going into 21. Paul will probably have some comments on structured, but I think what's interesting there is that the CMBS and ABS market, and I'm throwing a blanket over it, are sort of bifurcated between AAA and everything else. And people were not thinking about credit issues further down the capital structure back in February, and now that's changed. And we've seen that reflected in pricing on the high quality front, in particular in new issue. Of course, the housing market was expected to be a problem initially in the wake of COVID, and that's probably arguably one of the strongest parts of the capital markets these days in terms of fundamentals. So I think that's also being reflected in terms of valuations. The last 2 points, Europe, getting away from the U.S. for a second, had structural issues coming into COVID. Those have not gone away. In fact, the environment's probably been somewhat exacerbated, but that doesn't mean there aren't opportunities there, whether it's private placement markets in Europe or non-financial hybrids or even European high yield. And then my last point would be emerging market debt. It's not going to cease to be a major component of global GDP as we look ahead into 21 and beyond. And I think particularly in the U.S., given the fact that there's so much focus on investment grade credit markets and so much exposure there, I think there's a recognition that EM markets are far more stable than they were through crises like we saw in the late 90s. The fundamental picture is very different today. And I think people are looking for diversification away from investment grade credit markets. Point being that these events around U.S. election and virus have redirected some attention into areas that may have been less featured in portfolios historically.
Yeah, all very interesting perspectives. You touched on a couple of things that are worth following up on. This is a very different kind of downturn, right? And we might not even be in downturn anymore. But personal income is up, savings is up, residential real estate values are up. These are things that we don't typically associate with a downturn. And Paul, as you focus on the assets and coming at it from a structured perspective, with all of that taken into consideration, how are you thinking about 2021? We'll dig in a couple of questions into some more specific recommendations, but keep it at a high level. I assume all of this, and really as a function of stimulus, to be quite frank, has been very constructive for the fundamental underpinning of this economy. Would you agree?
Absolutely. And I think, Vin and Jason did a great job of really summarizing at a high level all the opportunities and as well as risk. And we wouldn't disagree with anything that they said. From a GDP and rate perspective, I think we're right there in line with Vin. Maybe we think that there's a little bit higher rate move with the steepening of the curve. But based on everything that we're seeing, and generally to keep it at a high level, Van, what we would say is the Fed, stimulus, they're all working to sort of the medical term is flatten the COVID curve. We think that our fiscal authorities and our monetary authorities are working to flatten any type of bad consumer curve, whether that be foreclosures. So they've worked really hard, in our opinion, to build a ginormous bridge over this crisis. And we think that because of that we liken it more to a hurricane or to a natural disaster, where over the next 24 months, we're going to be in a better position. Now, if we have this conference and we're still talking about the pandemic 24 months from now, that might not be such a good conference. But that being said, I think to keep it again high level, I would say that for us, the two main things that we're focused on as it relates to both sort of macroeconomics and structured credit is 30-year mortgage rate. I think that's an important thing to keep watch on. And the Fed has worked really hard to get that down to all-time lows. That's really, as I think it was Jason's mentioned, has really turned housing into a powerhouse. And we think that that does not stop. And that really gives consumers the ability to manage their debt, which, I have a few points on later that I'd love to talk about. The other thing that we watch really closely is something simple, but monthly pay rates on credit cards. And we think that's a good indicator of consumer health. And that's our main concern here is that, again, both Vin and Jason mentioned the liquidity buildup in a lot of these high yield names, and they've got a runway. So for us, it's watching the consumer, making sure that they can make their payments, making sure that they want to make their payments. And I would say where we sit today, much different than the great financial crisis, is that consumers want to continue to make their payments. They have equity in their homes, which they do not want to lose. So it really gives all the authorities the sort of requisite powder to continue to work with consumers because they have a bunch of built up equity. And as you mentioned, they're even saving more, which is kind of un-American and counterintuitive going into a recession. So I'll stop there. I think a lot of great things were said, and we can get into the weeds a little bit later.
Yeah, thank you all for that perspective. I think it's very helpful, and there's a fair amount of consensus across the thinking, which is interesting given the environment we're in. Now, Vin, as a follow-up, I wonder if we talk about the credit asset class a little bit. So in our data analytics unit, KBRA Altman, our 1 year forward corporate default rate forecast expected to be 6.8%. I guess below where many certainly forecasted that rate to go if we go back into the spring and summer. I assume that you think that given the vaccine developments, given the effectiveness of that ginormous bridge that Paul talked about, you're not worried about the default environment getting out of control here?
Yeah, I would say, Van, a couple of things. The number that you guys have put out, I mean, that might be a little bit low, but I think it is so dependent on what happens with the path of the virus that I think it's within shouting distance. So I'm going to take. I guess I would take the over, but not over by much. And I'd like to just circle back and point out a couple of things. And, Paul alluded to them just a second ago. We're coming out of this recession, if you like, this, super short, very odd recession in a different position as far as consumers are concerned than we did over the last few recessions. And that is, in this instance, you had neither housing collapse nor the stock market collapse, except for, a very brief period of time there. But, so the consumer balance sheet, if you like, the household wealth metrics are much better at the moment. So you start from a position of relative strength vis-a-vis previous recessions. So I would point that out. I am certainly not Pollyanna with regard to credit. I would point out that I think a lot of the bad news perhaps is already in the mail, and it's secular bad news that's been building. So retail is a story we know about. Certainly the energy story is one we know about. And that has accounted for quite a lot of the defaults. So I might take the over to your number, but not over by that much. And it might be, it might be right on to the extent that we get a quicker resolution to the COVID crisis.
Yeah. Thank you for that. Jason, what are your thoughts around credit? Are there particular points of vulnerability that you are steering clear of? How do you think about sort of the credit asset class here broadly defined?
Yeah, I mean, I guess we're bridging investment grade and below investment grade. And to your default rate point, I think not only is it the rate, but maybe more interestingly, the recovery. of any defaults that play out. So, from our perspective, that's probably the biggest difference in this cycle as things play out, and that's clearly been led by energy issues early on. To Vin's point, maybe some of that has effectively played out. I think to your question on credit, we sort of think about things in four different buckets. There are issuers out there that have sort of capitalized and adapted. There are companies, maybe more in the form of deep cyclicals that can sort of revert back to normal. There are some that are sort of managing through the crisis. Not all will make it necessarily. Maybe the weaker balance sheets will be acquired. And then there are those that are going to just have to surrender. It doesn't mean that they don't have good asset values, but those are the ones that are more likely to be acquired. I guess the pace of that evolution is really dependent upon what your expectations are around implementation. We got great news earlier this week. Actually saw the COVID-related names, particularly in high yield, react to that pretty strongly, at least right out of the gate on Monday. The adults sort of came back into the room on Tuesday morning, and things settled down a little bit. I think we're probably a bit more cautious in how fast things return to normal in practical terms, but that doesn't mean, particularly given our starting point, that's going to be reflected poorly in terms of valuations. So, recoveries on the one end, and then how much closer we are to normal by the end of 2021 really kind of defines the trajectory. The last point I'll make is I think there's a lot that hangs on how long this credit cycle will persist. We came out of an incredibly long credit cycle. We went through something very quickly. Given the leverage dynamic, given the policy questions that are hanging out there, it wouldn't surprise me if we were seeing a different credit cycle this time around because of the starting point for central banks and their ability to really impact from a support perspective.
Yeah, very quickly, Jason, I'll follow up, and because of time, I'm going to hold you to 30 seconds or so. We did a lot of research on our end at looking at leverage, specifically, the often told story that corporate leverage in the U.S. is at an all-time high. Some would argue, I think we're in this camp, that coverage ratios are still very, very manageable, but leverage is leverage and debt is debt. And there's a real divide out there. Where do you fall on this divide? Is corporate America over-levered as a result, in part because of this very long economic expansion that we had and this broad availability of debt out in the markets?
Yeah, the quick answer is, coming back to the word idiosyncratic. So I don't think you can throw a blanket over the whole of credit markets broadly. And I don't think managers like all of us have been rewarded for doing a good job on the fundamentals front for the last 10 years because we've had so much central bank support. So I think the answer is it depends. And to Vin's point, having discipline around not chasing risk is going to be the difference in a world where the Fed's not going to bail out high yield credit markets. So I think we need to acknowledge that and let the market settle on what valuations make sense.
Very good. Thank you for that. Paul, let's turn towards the world of structured finance for a while. We always look for what's going on, I think, in the structured world for things that maybe the broader markets aren't looking for. So maybe a canary in the coal mine. Where do you think the vulnerabilities are in this credit cycle in the structured finance world, and where are you finding attractive risk and reward?
That's a good question. I think, again, the guys have done a great job. And what I would say, the word that I heard, idiosyncratic or different markets, we think that really the vulnerabilities, specifically in structured, are going to be in places like student loans and unsecured consumer lenders, specifically some of the unproven fintech players And then, of course, in certain CMBS, the retail story has been well told. The office space story has been well told. But we think, kind of what we saw from the great financial crisis, we think that over the next 6 to 12 months, given it's still going to take a while for this to play out, a lot of these consumers are going to be forced to make payment decisions or triage. And so, we think what we saw last time in the great financial crisis will play out. Credit cards are going to get paid. Mortgages will probably get paid this time because they're in the money. Cell phone bills are going to get paid. Autos are going to get paid. So what doesn't get paid typically is going to be your student loan, where you can do a lot of forbearance. We think that's probably going to not do well over the next 6 to 12 months, as well as unsecured consumer that I mentioned. We think specifically that the fintech lenders are a little bit vulnerable here only because they don't have a relationship with the borrower. So if you're a person trying to make a payment decision, are you going to pay the person you have a personal relationship with, where you walk into the office and pay the bill, or are you going to pay the person that you're just a number on the computer to? So we think that the fintech lenders will probably see an uptick in potential losses, delinquencies, et cetera. In terms of opportunities, we think that, again, each bond is its own sort of unique entity, and that there are opportunities in things like timeshare. There's opportunities in aircraft, we think, especially at the single A level. And we think at the right time, when spreads are a little bit wider, there could be opportunities in CMBS where they have better properties, and that's a total re-underwriting decision. So really, again, back to that word idiosyncratic, lots of opportunities. I don't think we've ever been more excited because we can run bonds to our most distressed scenarios, and a lot of these sectors call it triple B and up. And many of these bonds return all their principal in very draconian scenarios, including the great financial crisis. So I'll stop there, but we're very excited about the opportunities.
Yeah, let me just, one asset class you didn't talk about was CLOs, held up obviously very, very well through the great or global financial crisis. A lot of curiosity as to how maybe some underwriting has changed in this go around. And of course, a lot of those features have been strengthened. How do you think the CLO market will hold up here through this turn in the credit cycle?
Frankly, if we had to take the under on the default rate and apply it to CLOs, we would take the under, because we think that many of the high yield names or the players in the CLO market, those companies really did all the right things in that they termed out their debt as quickly as they could. They tapped their lines with their banks. And unfortunately, the human element was they laid people off. So we think that they're in much better shape than much of the market is giving it credit for. And I think, frankly, that has a lot to do with some articles that run that, try to light the CLO market on fire. And we don't necessarily think that's true. We think the CLO market is really structurally built to survive. We've been big fans since the crisis, and, it is one of our favorite asset classes. We think it'll continue to do well.
It's good color. Thank you for that. So at this stage, I think we can all agree that COVID has changed the way we live, right? How we work, shop, spend our leisure time, et cetera. How do you take, your own experience, you think about all of those things and apply it to an investing strategy? What really has changed as a result of the pandemic? What are the changes that you're making in your investor or your investment philosophy because of the COVID? Why don't we go down the line again? Vin, do you want to kick us off?
Yeah, sure. I think I can be relatively brief on this one. I mean, as far as our strategy is concerned, I don't think COVID. I think COVID has accelerated certain trends in the marketplace. And in a lot of cases, those trends were already fairly long in the tooth. And we talked about retail and we've talked about energy. And I think some of those things were accelerated. The move to more technologically driven set of circumstances for many of us. I think all of us are sort of shocked at the work from home experience being as successful as it has been. I think we're all a little fatigued, but it's worked relatively well. So I think a lot of I would say our strategy really hasn't changed insofar as what we are doing or not doing. Maybe more importantly, we were sort of shying away from certain sectors for quite a long time in advance of COVID because of the secular changes. And I would say that's probably kept us in fairly good stead. One thing that I think is, helpful to keep in mind here is that we're going to just continue to stick to our knitting. The thing that COVID has really done, we started the year with a 10-year, I think it was about 190, 192, somewhere in that range. So we've lost fully 100 basis points, and spreads are, as Jason said, almost back to pre-pandemic levels. So now the challenge in front of us is scraping out yield for our client base in whatever way forward. So the strategy, I think, to the extent it changes, it's by investigating additional asset classes, perhaps taking more, somewhat more risk in a smart fashion in order to gin out as much yield as we can for our client base. So a little bit more aggressive, perhaps, at the margin, and pushing into some other asset classes to help, make up the yield gap, if you like.
Yeah. So really, the kind of a redux of what we were facing before coming into COVID. Jason, how about yourself? Has any great revelations to you, having gone through the pandemic here? Have you changed, your philosophy or strategy as a result?
Yeah, I think to Vin's point, it's, nothing's changed in terms of our approach to markets, but I do think maybe more the question you're asking is, how have the objectives, particularly in insurance portfolios, changed themselves? So, I think the thing we would all agree on is that you've got a wide spectrum of objectives that can play out, whether it's the life sector or the P&C market. You can get into some pretty specific, issues around quality and liquidity and income and return. So I think on that front, the thing that stands out to me is that vulnerability, particularly in the P&C side, of the opportunity to build the weight of capital through investment performance. We're coming out of a year where investment grade, sort of Barclays Ag type, portfolios, indexed portfolios are going to generate more than 7 or 8% in returns this year. That is not happening in 21. And so I think it's forcing a lot of insurance organizations to think about what their expectations are from portfolios. And then that obviously brings out the specter of risk. And I think the one thing that we have probably all recognized coming into this is that the street is not there to support you. So when there's a liquidity squeeze, hands go in the pockets. And I think we've all got enough experience with that playing out kind of post financial crisis. I think if anything changed for us internally more broadly, and I would guess my colleagues feel the same way, I do think the way that we communicate has changed in a significant and good way across our platform. I work at a global firm. We had great technology in place before, but I think the way we've enhanced the dialogue has probably been a real positive for us. And a lot of that will stay in place going forward, even though we're partially back in the office, which may be hard to believe. So I think on that front, that's probably the one thing I would say that has changed, not only internally, but the way that we communicate with our clients as well. The activity there that Paul mentioned, being in front of them more often and being more clear about what's happening in markets has been a big change.
Great. Paul, your thoughts? Is any notable changes in the way you think about the world from an investment perspective post the pandemic, if we are post the pandemic?
Again, I mean, I love going third because these guys are just crushing it with the answers. But what I would say is that to sum it up, there's nothing like being tested through the fire, and that our processes held up. We were very proud, like everyone else of the guys on here are proud of how they came through it. So we feel like that the technology, the way it worked, only reinforces the process. I do agree that I think clients are definitely looking to take more risk coming out of this. And so I think one of the changes, could be where you see different clients asking for different risk metrics as we move forward, which could be a change in terms of systems, reporting, that sort of thing. But as far as the investment process, I think, it held up well, and here we are.
Here we are, indeed. Thank you all for that color. So we turn a little bit to a theme that I think you've all touched on, and that is how your strategy might be evolving into other opportunities, other asset classes in a world in which 10-year grease paper trades inside of 1%, 10-year BBB Verizon paper prints inside of 2%. In a world where $17 trillion of bonds have negative yields, all seems bizarre to anybody who's been in this business for a while, but here we are. It is tough to find good yield. We've been on at least probably a decade-long search for yield, anybody sitting in your seats. Now, from an insurance perspective, you are all presumably in a position where you can take on illiquidity, you can take on complexity, more than indexed managers. Talk about the opportunities you see in the private markets. To what extent are you making that out of public securities and into the private trade? Is this a big wave of activity, or are you being very, very tactical around that trade? Vin, do you want to give us your view?
Sure. I would say from our perspective, really not much of a change out of public to private. What I would say in regard to our use of private placements 144A, I mean, we're doing that mostly on the structured side because yield per unit of duration there looks fairly attractive to us. On the corporate side, if you look at spreads afforded by privates versus publics, in general, those spreads are a lot tighter than they were 10 years ago. And so in our estimation, better to use the private or 144A capacity elsewhere. What I would say is that we're ginning up more value, if you like, by adding incremental asset classes. And that could be certainly within structured, a host of interesting securitizations that you can participate in there, but also adding things like preferred stocks, which pound for pound are you can accept the subordination for a fair amount more yield, and also dividend-paying stocks are a good addition, we think, to portfolios at this stage. So on balance, I would say not much of a change in terms of how we're viewing the public-private question, but really, certainly for the past 5, 6, 7 years, we have been pushing off into other sectors besides investment grade corporates, vanilla securities, if you like, in order to gin up some incremental yield.
Yeah, Jason, how about yourself? What are you advising your clients at Neuberger Berman?
Yeah, so I mean, I guess I'm fortunate to some extent because we've got this $80 billion, private equity, private credit platform, and you're right. I mean, the evolution, which frankly has been led by the larger private equity players, taking advantage of life balance sheets, taking advantage appropriately of life balance sheets, sort of set the stage there. For me, I think the central and critical theme here is that if you can access private markets in private credit space so that you're not compromising in terms of the credit risk you own, so private markets effectively allow an extension in the high conviction credit exposure. I think that matters to clients. In other words, not doing it for the sake of doing it. We've expanded our capabilities into the European private placement market because the banking system, frankly, just hasn't gotten out of its own way. And so there's a void there to participate in a crossover credit market where banks struggle to lend. And that kind of opportunity is a great complement to investment grade public credit portfolios and a yield enhancer. Similarly, in the private residential home loan space, where we think we've got a somewhat unique point of access, both in terms of sourcing and delivering in a capital efficient way, we can fill the gap where non-agency RMBS has been effectively melting away for the last several years and get a complexity premium out of that with arguably less volatility and diversification away from corporate credit. And then finally, I think we see this more prevalent among our Asia clients, particularly out of China and Hong Kong. Our multi-asset class team, where we're effectively building a foundation in conventional fixed income, but then layering on exposures to private equity, private credit, co-invest, and the like, where they've got challenges with respect to their liabilities, where we can fashion, particularly given the long tail nature of those liabilities, a solution that meets the near-term known cash flow issues, but then facilitates return farther out that will help them get to that objective.
Very, very interesting. And you're right, the breadth of being, or the advantage, I guess, of being global and having a private equity or private debt, private capital opportunities is certainly an interesting development and one that we see really across the industry. Paul, how about yourself? So I know on the structured side, I assume you're open to all sorts of esoteric things. How big a trade is that for you?
I would say that that's probably our biggest trade, in that we're very focused on private placements and esoteric ABS. We're hearing a lot from our clients about what can you do in that space. Specifically, we think, as all of us have mentioned, much different than the great financial crisis. So it means educating clients. But what we're most excited about in esoteric in some of these spaces is that these assets are trading at a discount to par. And it's a lot to do with just plain old uncertainty and fear. And not all these assets are going to lose principal. So again, we find it tremendously exciting that we can run our stress test and these assets don't take principal hits. The other part is, you're picking 300 to 500 basis points over competing corporates that have similar duration or similar rating. So we like that a lot. For us, particularly in esoteric, we've been sticking with timeshare. We definitely like select aircraft ABS, and these are mostly BBB or single A, rail car, triple net lease, CLOs you mentioned before. We don't necessarily consider that esoteric, but I think it bears mentioning because people might be thinking, what are you talking about timeshare? Isn't that sector blowing up? And I think, what's interesting about COVID is that things are happening that are strange and not usual. And I think timeshare, container, rental cars are three really good examples where, because of the high unemployment rate and other things, people have assumed that those sectors are not going to do well, but COVID has had a really positive impact. So I think the example here is that timeshares in mountains, at the beach, anywhere that's in driving distance, and most timeshares are within driving distance to the consumer, people want to escape, so they're going there, and these timeshares are at full capacity for the most part. So people are making their payment. They want to go there. They can social distance at these places better than hotels. And we've only seen, for example, 1%, 1.5% deferrals, very low delinquency rates on these assets. And, that really moves over to things like containers for a different reason, rental cars for a different reason. So, we think a lot of these asset classes make a lot of sense in an unusual world.
Yep, very interesting. The breadth of that is remarkable, but seems like a bona fide opportunity set and plenty of things to choose from in there. Now, in the interest of time, I want to leave a little bit of time for Q&A here, but one last question, and I'll ask you to be relatively brief on your remarks. But, the growth of ESG investing has been one of the more noteworthy investing trends that I can think of, and backed by a growing body of research that suggests that you can deploy values-based investing without sacrificing performance. Talk to us about, how you're incorporating ESG into your investing pitches and considerations. Vin, you want to start us?
Sure, absolutely. We are certainly committed to the concepts embedded in ESG. We are a PRI signatory, have been since last year, and we are incorporating the various components of ESG, obviously, into our credit evaluation process. I think this is going to evolve over time. I think, as we all know, there is a fair amount of subjectivity to this particular topic. I think the disclosures will improve over time. I think companies will need to be willing to evolve over time, and we are certainly ready, willing, and able to do that. So we have incorporated the ESG concepts into our credit selection process. What I would say is that there may be, because of the scoring mechanisms and because of the systemic preferences for certain industries, and actually predispositions against various industries, you may find some opportunities that crop up. And the obvious example is energy companies, in the fossil fuel space. Not all these companies are standing still. A lot of these folks are trying to move forward and build out renewables and things of that nature. And I think the market in general is not giving them any credit for it. I do believe some of the energy companies that are out there today are going to morph into energy companies of tomorrow. So there may be a little bit of baby with the bathwater there. And I think, if you're looking, as we always do, for opportunities, there may be some there. So I'll leave it at that.
Yeah, that's all good color. I think we would agree with you. It has been the Wild West out there in terms of scoring systems and how people are applying this. From our perspective, we really distill the whole thing down into management, right? Management has to be sensitive to ESG preferences among investors, but also, consumers of their goods and services, and how that management manages to those changing preferences is an important point. The other thing you brought up, which I think is relevant, is this really should be a dynamic process, right, as opposed to point in time. And that you're right. My guess is that there's going to be opportunities out there for those that are tarred by a particularly punitive brush simply because of where they are starting from. But Jason, let me throw it over to you. How important has ESG become to you, or as you and your clients? I assume there's a whole lot more interest today than there was a year or two ago.
Yeah, I'd underscore the point that Vin made, in the sense that this isn't something you bolt on to a credit process. Vin said it's got to be integrated, and that's absolutely the case. We have a dedicated team. We too are a signatory with A+ ratings across the board. I think where that puts us, though, is in a position to not only manage portfolios and strategy, but also advise clients. Because we have a lot more clients now that are coming to us saying, we've got to develop our ESG policy, whether it's a P&C company who's thinking about, some of the crossover or overlap issues on the investment side versus the underwriting side. And so really taking that more collaborative approach, I think is helpful and useful, because it isn't an exclusionary framework. A lot of people think about it that way. It's really defining whether or not you're being compensated for how those ESG risks are scored across the board. And so I think that's the value add ultimately. But to Vin's point, it's a dynamic conversation because everybody doesn't have a singular objective.
I hear you. Paul, on the structured finance side, ESG probably, it strikes me as probably not having been as forward as it's been increasingly on the corporate side. And yet you're still competing for investable funds, the structured finance world. And so how important has ESG, or how important is it to you? Is it something that is yet to really be defined, or are you starting to see the impacts of it already on the structured finance side?
Oh, we certainly see the impacts. I think what's interesting is that we probably didn't even realize we've been doing it for all these years, but we've been accidentally screening for ESG. And I'll give a good example is that, usury rates, or the way certain companies disclose information, or the way they handle foreclosures to the borrower is very ESG-like and has been a part of our process for a while. Now clients are asking us to further refine it. And I think your word of the wild, wild west really applies to structured in that it's really wide open. Interestingly, what we're seeing is a lot of clients are asking about client strategy implementation, and there's not a lot of climate strategy. And there's not a lot of climate, so to speak, in structured. So we're working on that to flush it out for our clients. They're definitely focused on credits, issuers that are, focused on it and doing a reduction strategy. So for us, it's really about building out compliance for that and help them. And we definitely have all that on the corporate side, and we're working through it on the structured side.
Very good. Let me stop there and see if we've got some time for Q&A. Steve?
Sure. Thank you, Van. And thank you, gentlemen. Great discussion there. Very technical. Really appreciated Van taking charge of that for me. We have got a few questions from the audience, so I think we'll just try and run through some quickly. We are running slightly over time already, but we can carry on if you're all happy to. We have a question related to ESG, which perhaps we'll open with. Do all the aspects of ESG get equal attention, do you feel, or is it more E and G with a little bit of S thrown in? Maybe we could pass that to Vin. I know NEEM are very hot on ESG and have been working hard in that area in the past.
Yeah, thanks for the question, Steve. I think these are, all the components are important, but they're not equally distributed. And so various companies are going to be in the spotlight for E. Various companies will be in the spotlight for G. And so, I think the notion of a combined score is a little difficult. But what I would say is each component is important in its own right. And to Paul's point, too, and I think it's an excellent one, the concept of ESG, the acronym is relatively new, but the notion of incorporating some of these things into your decision-making process is not new. As asset managers, we've done this for some period of time. It's a matter of assessing risk of various types. It might be governance risk, or it might be environmental risk. The social is a little newer and maybe a little softer, a little tougher to get your arms around sometimes, but I think all that's going to develop over time. The point I would make is each one is distinct, each one is important, but various companies are going to score differently on various components. So the combined score notion, I think, is it's evolving. We'll leave it at that. We're evolving, but look at all the pieces in isolation, I think, and you end up with a better answer.
Great, thank you, Vin. Yeah, it's an interesting topic at the moment. We've actually been running a survey on ESG recently with asset managers and reinsurers, and the findings are incredibly interesting, which we'll be publishing in a couple of weeks. Got another question from the audience here, which maybe I'll direct this one to Paul, given your experience at Conning and looking after insurers' asset sides. Do you think NAIC requirements are supportive of insurers in their search for yield in the current market environment, or perhaps proving a little restrictive?
I would say that they're pretty on point. And the reason I say that is that, for example, we can go into the private placement market and find NAIC, sorry, tongue twister, and level 1 or 2s that have significant yield over competing corporates. And I'll go back to kind of what Vin said before. For us, we think a lot of these mainstream, super large corporate private placements are tight. Our focus is on assets that are either securitized or have some structural component that are smaller size, where we can dictate terms a little bit better and where we can get better representation. In those cases, we do feel like, to go back to your question, NAIC 1 and 2 assets provide excellent return over competing assets. And I would say the same thing, and obviously I'm going to talk about structured, but a lot of these assets are still at 1 or 2 and representing great value over some of these corporates that, frankly, are yielding 1%, which isn't a fun time to be investing in corporates.
Sure, thank you, Paul. And so one final question quickly for Jason as well, if you have the time. Any thoughts as to how insurance-linked securities might fit into your portfolio? And this is from the audience. You might think it's from me, but it's not.
Well, I'm fortunate with my days in Bermuda to have a pretty good understanding of that market, and I think we all appreciate the correlation elements or the role that ILS and that whole marketplace can play. It's challenging on the life side, just from a capital consumption perspective, because these are less likely to be rated, and I think there's a lot of overlap potentially on the P&C side. But as an investor, there's no question that when you're thinking about uncorrelated exposures, there's a role to play, and I'm glad you asked, because Neuberger does have an enterprise out of Bermuda on the ILS front. So it's definitely something that we see being leveraged more broadly outside of insurance markets, more so, and is a fantastic opportunity to complement other private market solutions. But I think we're all aware in the industry of the challenges, particularly where overlap or capital come into play, but it doesn't mean that there isn't a role for that segment of the marketplace in some way, shape, or form.
Great, thank you, Jason. And maybe one last thing for you, Van. Private capital in the industry wrote about Brookfield Asset Management setting up a new reinsurance entity today, and they're feeling that the assets they gain from annuities reinsurance can easily be invested and outpace the rate of cost of liabilities on that portfolio as well. What's your thoughts on private capital in the industry at the moment?
Well, I think we will look back on this era post the GFC as one where the rise of private capital has become a very strong pillar of the financial community. For reasons that probably make sense from a policy standpoint, policymakers wanted to take the depositories, right, the banks, out of a lot of the riskier assets that were all over the balance sheets prior to the GFC. And, one of the beautiful things of capitalism is that capital is going to find a productive use. And so, we've seen this proliferation of private capital really become, again, a very important part of financial intermediation. Big capital pools are valuable to every industry type and sector. And I think insurance is probably no different. And so, there's a natural value creation that can take place, especially in this kind of environment of stretched valuations, very low yields. There's room to open up that pipeline between private capital and the insurance industry, and my guess is the industry will welcome it and benefit from it. None of these transitions are ever without bumps. So we will watch to see how all of that plays out, to see if you get an instance where too much capital chases things and you get irrational valuations, and we know how that can end. But in general, we view the rise in private capital as, again, a positive thing in terms of financial markets.
Great, thank you, Van. So with that, we've run over now. So I would like to thank all of you, my panelists, for today. That was a fantastic session. Thank you, Jason, Paul, and Vince. And thank you, Van, as well, for taking over moderation there. Really appreciate it. So just quickly for our audience, we're back on Monday. We have 2 sessions for you. You can find full details on those on the event website. And thank you for tuning in.
Thanks, Steve.
Thanks, everybody.
Thank you, everybody. Thank you, Steve.